Throughout early March 2026, the sentiment was bleak. The market was fearful, the price was stuck consolidating under $67,000, and traders pushed heavily into short positions, betting on a severe drop toward $55,000. But on March 8th, the price quietly slipped above the 68,500 resistance line. That exact movement began tripping a cascade of stop-loss orders. This chart shows the mechanics of what happened next. When a trader shorts an asset and the price goes up, the exchange forces them to buy back their position to cover the loss. That forced buying pushes the price even higher, which liquidates more short sellers, triggering a continuous loop of mandatory buying. That loop spun out of control. Over a single 48-hour window, $1.5 billion in positions were wiped out as the price smashed straight through the $75,000 barrier. Markets move in the direction that inflicts the maximum financial pain on the highest number of participants. In this instance, over 130,000 traders betting against the trend were liquidated in 24 hours. Now that the immediate chaos of those liquidations has cleared, the market is left with two contradictory sets of data pointing in opposite directions. Deep internal metrics suggest a sustained upward cycle is beginning, yet surface-level trading data warns of a technical trap designed to wipe out late retail buyers. Navigating this phase requires stripping away the emotion and actively weighing the raw blockchain data against the warning signs appearing on the trading charts. We start beneath the surface. On-chain data acts as a record of truth for the market, showing us what investors are doing with their holdings, rather than just what speculators are trading on the surface. This chart shows a divergence. While price rises, Bitcoin held on exchanges has dropped to a 2-year low, reducing available supply. Furthermore, a record 76% of all Bitcoin hasn't moved in over 155 days. The freely tradable supply is exceptionally thin. We also see a shift in the SOPR, or Spent Output Profit Ratio. This metric tracks if moving coins were last bought at a higher or lower price. In early March, it spent days under 1.0 as investors sold at a loss, but it has since recovered above that baseline. The internal blockchain metrics show that patient, real capital is absorbing the available supply and locking in a higher price floor. The entities pulling supply off the market are Wall Street's largest asset managers. BlackRock's spot ETF alone recorded over $2.8 billion in net inflows. That corporate demand is compounding. Fidelity reported significant subscriptions, and Strategy executed a $1.6 billion single purchase during the 9-day rally window. This capital inflow is happening despite a restrictive macroeconomic backdrop. Inflation remains at 3.1%, and energy prices have surged, topping $100 a barrel. This environment is keeping Federal Reserve interest rates at their highest levels in years. Yet escalating geopolitical tensions globally, combined with a landmark SEC and CFTC ruling, have strongly reinforced Bitcoin's growing reputation as a safe haven asset. By clarifying that the majority of crypto assets are not securities, regulators have allowed investors to treat Bitcoin similarly to traditional gold. Even with high interest rates working against risk assets, institutional demand and regulatory clarity are currently at their strongest levels in the asset's history. But if you look directly at the technical trading charts, the data contradicts the fundamental optimism. This chart tracks the relative strength index. Right now, it pushes past 75 into heavily overbought territory. Alongside that, perpetual futures funding rates are spiking, indicating a crowded trade where investors pay a premium to bet the price will climb. While the retail sentiment index has snapped into extreme greed, the actual trading volume has steadily declined since the initial $75,000 breakout. High leverage combined with dropping volume has historically preceded a downward shakeout, clearing out speculative positions before a more sustainable move can occur. We are navigating a market caught between a rising fundamental floor and a heavy, over-leveraged technical ceiling. The presence of BlackRock, Fidelity, and Goldman Sachs indicates Bitcoin has transitioned from a fringe experiment to a permanent component of the global financial system. However, institutional integration does not exempt the market from the laws of financial gravity. High leverage still leads to corrections, and short-term drawdowns remain a feature of this asset class. In 2026, the primary challenge for investors has transitioned. While earlier cycles were defined by the struggle for the asset's basic survival, The current challenge is navigating massive volatility introduced by institutional scale leverage. This chart outlines the immediate future. Conservative investors should avoid chasing the rally, waiting until price tests the $73,800 support zone. For increasing exposure, the target is $80,000. A weekly close above that level indicates the technical trap is disarmed. With funding rates at their current levels, strict stop losses and the avoidance of high leverage are the only ways to ensure a position isn't wiped out by a standard correction. Long-term data points to a sustained cycle, but success in 2026 requires patience to let the short-term speculative froth clear before committing new capital.